And now, it's time for the show that breaks down the options market. From unusual activity alerts to market updates and trading strategies. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the option block. With your host, Mark Longo from theoptionsinsider.com and co-hosts Mike Tusaw from KnowYourOptionsInc.com and Mark Sebastian from OptionPit.com. The Option Block is brought to you by Options Express. Don't spend time worrying about your broker. At Options Express, security, stability, and account protection are the most important responsibilities to our customers. Secure account access, enhanced financial protection, entrusted with over $7 billion in customer assets, established financial stability. Options Express lets you trade with confidence. Stocks, options, and futures, all in one account. Trade with a specialist. Visit optionsexpress.com/OXradio to open your free account. Options Express is a member of FINRA, SIPC, and NFA.
All right, everybody, welcome back to the Option Block. We are, of course, your bi-weekly source for all things options related. My name is Mark Longo from a little thing we around here like to refer to as the optionsinsider.com, as well as from the Options Insider Radio Network, the home, the originator of Options Podcast, and indeed also the home of this fine program, the Option Block. You can, of course, find us in all of your favorite podcast providers of choice, or you can just go to the website, stream it, theoptionsinsider.com. Lots of great choices, lots of easy ways to get this content. We're making it even easier for you going forward. We're working on a mobile app, working on finding more ways to get our stuff embedded in your in-dash providers in your car, and a lot of great ways to make it even easier to find the Option Block and all of our other great shows here on the old Options Insider Radio Network. And joining me on the old all-star panel today, we'll start off in order of proximity. He is the closest, and indeed he had the tastiest lunch. He is known far and wide as the Viceroy, a.k.a. Alex Jacobson from Options Express. Alex, welcome back to the show, sir.
Hey, Mark. Good to be here today.
I think that lunch made you wired. You can just feel the energy in your voice, Alex. Just dripping with enthusiasm. You have to stop having sugar and lollipops for lunch every day.
Yeah. Given the market action, today lunch was the highlight of the day.
Yeah, I guess that's an appropriate response given the activity on the street today. And also joining us from hither and yon, a.k.a. someplace they call Maine. You know him as the Rock Lobster, a.k.a. Andrew Giovinazzi from OptionPit.com. Mr. G, welcome back to the show, sir.
I am thrilled to be here. Maine is about ready to get washed away in the rain. Isn't that from My Fair Lady or something? No, that was the rain. The plains in Spain are mostly in. I can't even remember that anymore.
Something along those lines. The rain in Spain falls mainly on the plain.
Yes, the rain is
a great little enunciation tool we like to use.
What a mental dyslexic I am. Nothing to do with my vision, everything to do with my poor memory.
And even though he is far, far closer in terms of proximity than Mr. G, the Skype gods do not appear to be smiling on Mr. Tusaw yet again today. He is having some trouble connecting to the show, so hopefully we'll get him in a few minutes. But now we're going to keep on rolling right on into our first segment, the Trading Block.
The Trading Block.
All right, listeners, those bells mean that it is time for our beginning segment, the start of the show, a.k.a. the Trading Block, where we break down the day's worth of activity on the old street from an options perspective. And as Alex alluded to, there really wasn't a whole heck of a lot of activity to break down. Most of the major indices closing down fractionally lower on the day, 1/3 of a point on the S&P and about 1/4 of a point in the NASDAQ and the Dow. that's really about it. We had some news weighing on the market, including Lulu. We'll get to Lulu in a little bit. Other than that, not a whole heck of a lot. The jobless claims numbers, I guess, are a big scam. There's some errors in those numbers that were kind of weighing on the market a little bit today as well. But other than that, not a whole heck of a lot in the way of news, not a whole heck of a lot in the way of activity. Senior Andrew, we saw a little bit of a tick up here in the old VIX cash closing today. It's still ticking as we are talking, all the way up to 14.29 on the day. Any of that activity out in that realm surprise you today?
Not particularly. What surprised me was how far it went down yesterday. You still have the bobbleheads in Congress arguing over about the money we don't have to spend. That's happening, November, October, somewhere around there, FOMC. And the Syria thing, which looks like it had a peaceful resolution. Now, Assad saying, "Oh, well, I'll give you my chemical weapons unless you say you won't bomb me." So now he's telling the United States what to do, which I find this a very odd turn of events. Not trying to become political, but now the guy we're about to blow up is telling us what to do, which I don't know how we got into that position, but I find it funny nonetheless. So far as VIX land goes, it's perfectly acceptable for VIX to rally a little bit after a punishing sell-off over the last 3 days. We actually option pit, we closed volatility yesterday, short volatility yesterday and this morning. We don't really have any, at least in the vol products anymore. We're kind of watching to see how all this turns about, so to speak. So it didn't surprise me that it rallied. Like I said, we did close some positions, and I wouldn't be surprised if it goes higher. What really surprised me actually is how low the volatility is in oil. It's actually kind of at a 1 or 2 month low right now, which, given kind of the job owning, I find it surprisingly low.
Yeah, of all the products right now in the current geopolitical climate that you would not expect to be at an all-time or at least a near-term low from a volatility perspective, I think oil would be at the top of that list for most people. And
yeah, it's freaky, actually.
It's like they're playing the contrarian.
I mean, what's funny is, so oil basically is sort of back up to the highs where it was not very long ago. And you have 30-day volatility clocking in here at I'm not going to say it's at it's like a 1 month low today. So, I mean, I guess, oil rallied, volatility comes in, but I mean, it just rallied from 34 on all this kind of gobbledygook on Syria and whatnot. So I really don't know what to say about that. So we bought more oil volatility today. That's the simple answer to that.
So you're saying you loaded up in USO options because that's your favorite product of all time?
We bought a little a couple days ago. It actually worked out because the front month, it was like just a time spread, and we bought a little more. I haven't loaded the boat on it, but we've definitely been taking a taste here, as it were, at this level.
I was just joking. You're not using USO options, are you?
Yeah.
Oh, you are? I thought that was one of your least, or does that fall into your predictably crappy realm?
It's predictably crappy, so if we're going to short something, I want to short that thing. We don't buy it like, as I would say, a pure back spread, more like time spready out of the money stuff, where it's going to be kind of slow and crappy and stuff like that. I'm looking for slow and predictably crappy on that.
I'm sure that's a ringing endorsement. USO will be sure to put that in their marketing materials. We are the slowest and most predictably crappy of all the commodity ETFs.
It will be slow and crappy, and it will eventually go down a little bit, most likely when oil goes down. So there is a position for that called an out-of-the-money time spread. Out of the money put time spread. So we'll see what happens. So far, so good, though.
And speaking of the commodity realm, we are now joined, the Skype gods have smiled upon him, by one Uncle Mike Tusaw, beaming in all the way from the world HQ of RCM out there in scenic and sunny St. Charles, Illinois. Uncle Mike, welcome to the show, sir.
Always happy to be here, especially on a day like today when had a little bit of movement in the shiny stuff.
Yeah, I was going to say, we were just joking about how it was a very quiet day, but from your perspective, it probably was a very low BBI day. Of course, the major metals have been just taking it on the chin today. Both the major ETFs here, GLD and SLV, down substantially on the day. Gold, GLD down about 3%. And SLV, which I'm sure most of our listeners are using to trade these products, down about 5.5% today, about $1.25. So a lot of aggressive pounding. Perhaps we'll start there since we're on the commodities tip right now. What's your take and what was your response to these aggressive sell-offs out there in the metals?
Well, I'm still a long-term bull on both the metals. My covered call went in the money a couple weeks ago with gold and silver, and so today was a much-needed pullback in terms of trading the covered calls. What I've been doing, I basically have become a put seller who happens to be trading covered calls, so to speak. As my covered calls went in the money, what I've been doing the last couple of weeks is I've been doing these calendar/diagonals, actually calendars and diagonals, to just kind of have something in place in case the metals were to continue to go higher, but I never rolled up the covered call. It worked out. I looked into rolling up the covered call. It didn't. It was more beneficial, I felt, to just set up these diagonals and calendars in case it were to go higher. So anyway, with silver, what had happened, silver came down, and I was short the 20 call, actually, going into today, so it really didn't hit the big position that hard at all. So I rolled out to the October 20 call on silver, and if we proceed higher, I'll reinitiate some type of a calendar or a diagonal to hedge in case we go higher. And then on GLD, I was short the 129 call, and same thing there. If we do, I actually did not roll down there. I still am short the 129 call in GLD. But if we do start to rally, I will reinitiate a calendar spread in one way, shape, or form. Vol is working out okay to do that still. But granted, we had a pretty big vol jump for obvious reasons in the metals today, and that's what we'll do.
You know, I think it's just a sign of the times and the conditions right now in the marketplace that they're having experienced a prolonged rally for an extended period of time. That I just can't recall any other time here on the network or on the website where we've been inundated with so many questions about rolling covered calls. It's everyone and their mother wants to know, what do you do when you go through your strike? It seems like it's every day we can't stop answering that question. And here we are talking about it again in the metals. It's rolling covered call time, it seems. That's just everyone wants to talk about in all of our shows. It's interesting stuff. And so
just the one message that I want to bring from this, folks, is that if you panic whenever your covered call goes in the money, it's not gonna end well most of the time if you panic about it. You need to have a plan, and these are plans that I have had laid out for many years in terms of like what I do when the covered call goes in the money. There's a different thing you can do every time, obviously, and with the new weeklies, I could stay up for days looking at different choices of what to do. But if you panic because your covered call goes in the money, it's not going to be a good thing. The thing that I like to point out to people is that if someone has a short put out of the money or a bull put spread out of the money, and the stock starts going against them, and you hesitate to take action to roll it out because you're high on hopium that the stock's going to come back, well, if that's the case, then you're asking for trouble, because the next day if you have a gap down like we did today in gold or silver, it's going to bite, and it's going to bite very badly. But if your covered call starts going in the money, and if it goes a little bit more in the money, you're not going to lose anything. You're technically gaining money, and you need to look at the bottom line of the account when doing so. So I actually have a credit spread story from Apple to tell, too, a little bit later once we get into that, because Apple had a little bit of movement the other day, I think, didn't it? Oh, yeah, it did. But the thing is that if you're so focused on not capturing every penny of your profit and you're not worried about what your risk is, it's not going to end well.
You know, we do another show on this network called Options Bootcamp, which is very much instructional on these types of topics for basic retail. And we've been inundated with questions about rolling covered calls on that show as well, as you might imagine. And I laid out on that show one of my favorite strategies. I'm not sure if I discussed it in detail. Probably it's been a while since I discussed it on this show. But I laid out my strategy for how instead of using the traditional covered call stock and short a weekly or short a front month call, swapping that stock out with a leap, an in-the-money leap, maybe 6 months, maybe a year, maybe longer, and all the benefits that could really bring to your position from a Greek's perspective and everything else like that, from a capital efficiency perspective. And that blew a lot of people's minds because people already were concerned about growing through their strike, but at least they had the stock to call away in that moment because they could understand it. Now they have this funky time diagonal spread and they had no idea what to do with it. So we spent a lot of time walking through some different scenarios on that front as well.
So you put the Vulcan mind melt on them by doing that.
Essentially, yeah.
Something they could understand with the buy right to the diagonal time spread, and they all started to twitch.
Yeah, I pushed the wrong button. Because the people get nervous even when they already have the stock and it's just going to get called away. That's a pretty straightforward transaction. When you get rid of that stock component, now the safety net is gone. Now they have no idea what's going on. It was interesting to see some of the reactions to that. Once they get their heads around it, though, they seem to like it and understand the value that it brings to the table. But it was kind of interesting to see just the innate panic that comes when they hear something like, "Where's my stock?"
We have people doing that, like the SPY. It's a pretty nice little strategy for if you're going to own if you're going to own the market instead of like an ETF. I mean, it's you generate a few more bucks by being able to write some weeklies against the whole thing with a heck of a lot more money, less money at risk.
Exactly. I mean, if you're doing covered calls all the time, and I'm sure a lot of our listeners are, then you should be investigating that strategy. You should be using leaps or some sort of stock proxy, if for no other reason than just for the capital efficiency of it and put a lot more capital to work more effectively in your account. And forget about all the other reasons we could cite, which are many and varied. But yeah, if you're a covered call guy, then you should definitely be investigating that if you're not already. Now, Uncle Mike, speaking of rolling covered calls and a lot of movement and a lot of crazy business going on, your other big holding out there, some fruit company, I'm not sure, it starts with Q, I think. They had some news, of course, we talked on our last show. We were just heading into the big announcement. As we always say with these Apple announcements, buy the rumor, sell the fact. That certainly played out again this time. We were talking at the time, I believe prior to the announcement, that weekly, I think it was the 505 straddle at the time, was trading around $17. So they were pricing in a fairly decent move, but they got blown out of the water because this thing moved to about 40 handles actually at the low point there. So an aggressive sell-off off this 5S, 5C, I forget what they're calling the new ones, but apparently, as always is the case, the street underwhelmed, and yet everyone's going to buy this thing anyway. So what was your take on all this flurry of activity out in Apple?
Well, the first thing was, let's talk. Plenty of thoughts on that, but I might just tell you about how I played this from an option perspective and the importance of it. If you have one of my rules on a credit spread, and this is one where the position that I had going into this week with Apple, we talked about on the show on Monday, was that long the stock, long a 450 put for April, and then short a 470, 480 bull put spread. And the concept behind that on the put spread is to finance the cost of the long put further out. It was a weekly. So with that, going into the end of the day on Tuesday, I actually was able to close out the put spread for I got about 80% of the potential profit on that put spread. So one thing, my opinion on credit spreads is that very seldom do I ever let them expire worthless. I remember when I first started trading, what I liked doing was letting put spreads expire worthless and go for the coveted clean screen on Sunday night after expiration and start over again the next month, and it's just that easy. But one thing that I've found is that last 20% that you get, and for some people maybe it's the last 10%, maybe it's the last 15%, whatever way you want to look at it, that last bit of money that you're trying to squeeze out, that's very difficult to get. And a lot of people don't realize that because you have to go into expiration, you have to go into settlement, and you don't know what could happen. So with that, I'm going to give you a success story from it. I got out of my 470, 480 spread, weekly spread for the week on Tuesday. I had captured all the profit that I I would have preferred to be able to get out at a full profit, obviously, but I'm not going to try and chance it. Most of the time I say, oh, well, I could have stayed until the weekend, but this would have been one to where I would have had a 100% loss or pretty close to it. It's back up at 472, so I only would have had an 80% loss, I guess. So this is one where I'd encourage everyone to really use this as an example of how caution and staying in the game, things that we preach all the time on this show, and pretty much anyone who's halfway worth their salt as a trader preaches. This is another example of how this kept me alive, and it could have been a disastrous week, but now it's been a great week from a trading perspective.
Yeah, how many times chasing that last 10 or 15% worth of the decay, that last nickel or dime, do you end up forfeiting the entire rest of the amount that you've made? That last little bit is very, very difficult road to hoe.
It's totally stupid. Totally stupid.
You know, we say it here on the show many times, listeners. It's from bitter experience. It's not because we're any sort of preaching. It's just don't chase that last nickel. It's not worth it. That last dime.
I got slapped once, and that was it. I don't want to be slapped again like that.
Yeah, it only takes once, and you're like, wow, this really was quite foolish.
Yes.
You know,
I are such an idiot. And what we call that is like the insurance value. The options actually kind of flip-flop to basically, insurance. They become like pure risk insurance products. So they just don't decay like a normal option, even though it says there's decay. They really don't, because basically nobody really wants to sell a whole lot of options that have small dollar value. There's not a lot of liquidity for the product at that point. So, that red graph, that red line graph or whatever, if you're using all the, or the P&L graph, I guess, where it shows you that little peak where you make your maximum profit if you just wait till then, ignore that. Take a percentage of what you're going to make and be happy.
Yeah, I think if there's one way I would revamp options education, I think I would burn most expiration graphs. They have their place. They are somewhat useful in the beginning days, but they're just the crutch that everyone leans on right now. And I always hate to bring them out. I try to never do so whenever possible. Sometimes it's just the best way to illustrate a very, very stark concept. But for the most part, here's how it looks at expiration is a meaningless thing because you're never going to get there. 80 million things are going to happen between now and then that could dramatically impact the profitability of that trade and are far more important than how it looks at expiration.
Yes.
It's yet so many people, that's just the crutch. Here's the trade. Here's how you put it on. Here's how it looks at expiration. Go forth and prosper, young man. And it really works that way.
And like teaching people about trading, and probably Mike has dealt with this with customers, is people believe what they see. And you see a graph, you're like, well, that's what I'm going to make. And all of a sudden it becomes imprinted on their hard drive in their head, and you can't erase it. Because they're kind of pegged to it. And that's why you got to learn about Greeks, and you have to learn about how a position changes, so you can have a more realistic expectation of, being able to take profits and, and to trade your position essentially. So.
Alex, you've been educating the masses far longer than any of us here on this show. What's your take on the expiration graph and how it's just become the go-to crutch for so much of the options education?
Way to teach options. And even when we started the school at the SIBO, we had this great debate about teaching payoff diagrams, and I was in the minority of one. But the thing is, to Andrew's point, people have learned it that way for years, and it's just worthless. The likelihood you're going to be in there at the end is extremely unlikely. And to Mike's point, I did a webinar the other day, and I did a hub webinar, and we're talking about credit spreads. And I talk about the fact that the only way you're ever going to max out is to stay in to the very end. And that's probably not the best way to trade. And number one, a lot of people get greedy over commissions in that last nickel. And let me qualify it by saying greedy is my term. But it's stupid, because if you can get out with 70 or 80% of what you're going to make, move to another position and, move on. But waiting to the very end, this whole conversation about covered rights and waiting to the end is all about the psychology of investing. And it's so funny because the covered right question has come up, in my career, 10,000 times. And the funny thing is you get this. People write a covered call, the call goes in the money, and then they start rooting against their own stock. And you sit there and you go, what the hell is that? And the thing is, if you're a spread trader or if you're a covered right trader, think about what the parity trades are, right? A covered right is just a time spread. It's a perpetual instrument against a short-dated instrument, and it's in many ways the worst performing time spread because it takes so much capital. So, when you teach someone to say, look, a covered right is really just a time spread, to your point, Mark, then you say, well, maybe instead I should buy something 4 months out and bang out weeklies against it every month. And by the way, even if the stock does go up $5 or $6, or even if my short strike does go in the money, the longer dated thing I bought is now up 40 or 50%. Take it away. Take it away. When I can walk away from a trade with 30, 40, 50% profit, beat me over the head. Do that to me every day. I quote the Blair Hull story frequently. It's not how to get rich, it's how not to get poor. And one way to get poor is sitting in something that's worth a dime, waiting to get the last dime out of it so you can save a commission and earn a dime. It's bad risk reward.
Very bad indeed. And speaking of some bad trades, I think it's time to keep on rolling right on into the odd block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the odd block.
And that funky tune means it is time for the odd block, the portion of the show where we break down the interesting and or the unusual paper that's lighting up the old options ticker today. Going to kick things off with an odd block special. Mechel OAO, there's a ticker symbol MTL. They closed today at a whopping $3.62. Yes, it is indeed an odd block special. This is the name that also does a whopping 1,000 contracts a day. And today, lighten up the old tape with a total of 9,500 contracts on the tape. The bulk of that coming in one massive trade with a little side trade adding most of the rest. The bulk of that came in a massive block of 5,000 of these AAPL puts. So these are about $1.50 in the money puts now. Trading, the stock was down a bit today. So at the time they were trading for about $1.20. 5,000 times they went up about a few cents over parity. Stock has since sold off, so they closed $1.35 at $1.50. This is the strike that has 5,600 contracts open on it, so it looks like this is probably some closing paper. We also saw here about 3,600 of the AAPL going up as well today. So those look like they traded for about 45 cents. And those appear to be, looks like a buy as well. So it could be someone, and with about 3,500 open on that strike, it seems like someone could be closing out some sort of funky ratio here in the old Mechel OAO. Am I pronouncing that right, Andrew? Is that Mechel?
Mechel? I think it's Mechel. Or
with the high holy days approaching, I shall call it Mechel in honor of...
we can call it because it's Russian. We'll just call it Mechel. It's their big steel company, or a big listed steel company. The funny thing about these trades, I think, they didn't go up Mark's spread. It looked like a couple but I'm trying to figure out like the AAPL puts, Mechel has just had a big run from like, say, the 3 handle to 375 or 380. So I don't know what that guy, it looks like he's kind of closing a stinker. He's long some puts, and now he is selling them out. I mean, they closed for essentially for parity, like 2 cents over. And now the 4 puts looking the other way. Actually, I think I wrote up a Mechel trade a while ago. I'm pretty sure about it. And it looked like a put and stock buyer when it was trading around 275, something like that. So it has had quite a little run up. So I just think I don't think this has worked out for the 5-level put guy. Essentially. Because I don't know where the heck they're buying them because we're trading like pretty much right near the near-term highs. I mean, 395 was the high. I mean, maybe they might have made a couple bucks on them. I was trying to find out when they opened the trade, what the date was, but I couldn't find that. So, but other than that is that the stock has made a power run over the last 5 days. I think essentially since the Russians stepped into the fold, I think all the Russian stocks rallied.
It must be because of Putin's little op-ed there in the New York Times. You see that where he said it's dangerous to tell people they are exceptional or something along those lines? He's really raised a lot of hackles with that one, it seems. Essentially saying, Americans, you are not exceptional. It's dangerous to say so. And a very pre-communist block meltdown type of point of view.
It's pretty awesome because he's just riding the fate road to the rescue. He's just making, I don't know. I think he's kind of making us look like a bunch of dopes, to be honest.
Yeah, the whole thing, who knows? We're not going to go into the punditry land here on this show, but not exactly the most, let's say, well-played bit of diplomacy on our end.
Now the Syrians are demanding that they not be attacked if they give up their weapons. So the people we're supposed to bomb are now telling us we can't bomb.
Yeah, exactly. How dare you bomb me? And I don't want to even go out on this road, maybe, but let's just really quickly. What kind of weird driver of political action is it? Well, this guy is slaughtering people wholesale. What does it matter how he's doing it? He could be tickling them to death. If he's gassing them or giving them nice bathtubs and they die, what does it matter? If he's killing people in some sort of rampage, shouldn't we stop them regardless of the method? I don't know.
How about that?
I'm confused, but whatever. Let's go to Wendy.
Yeah, let's keep moving on before we go down a very deep path and we turn off all of our listeners both sides of the aisle.
What is that? Our rat hole? What do we call it?
Call it a dangerous political nonsense hole, is what we'll call it.
Yes.
Let's move away from that very quickly into something far more red-blooded American. Wendy's, good old Wendy's hamburgers. You can't look at that smiling little cherubic pigtailed face and that sign and not feel like a true red-blooded American. And they closed today. Little bit pricey for an odd block name, $8.62. I guess the Square Burgers are up about 4.5% today, so I guess the Square Burgers are doing all right for them over there. He came to my school when I was still in college, and he spoke, the former founder, I forgot his name. Dave Thomas, yes. And someone asked him, why are your hamburgers square? And he looked at him and smiled and said, because at Wendy's we don't cut corners. I thought that was a fantastic line. He clearly made the burgers just so he could have that line to throw around.
Well, I mean, he somehow managed to create a big burger chain when there was already a Burger King and McDonald's.
Exactly. He
wasn't stupid.
He carved out a niche. Wendy's, moving up today about 4.5%. We saw some action today. This is the name. It does about 1,900 contracts a day. Saw some serious action. 16,000 contracts going up in good old Wendy's. A lot of it on the call side. We saw on the SEP 8s, we saw a total of 3,400 of those going up today on open interest of 4,400 contracts. They went up for prices around 55 and 60 cents in some scattered lots. It looks like on the surface this was just a covered call writer, and again, going back to buying back the covered call when it blows through your strike. Looks like that's exactly what this guy here was doing, buying them back for 55 and 60 cents. Wendy's has been on a bit of an upward tier of late. Ever since July and their earnings, they broke through the 7 strike and have never really looked back since. Like I said, closing today, $8.62. This guy obviously taking his covered calls off the table. We also saw the SEP 9s having a little bit of action, about 500 of those going up. But we'll see what's going on in that strike range. And a lot of other scattered stuff. We saw, of course, these Nov 8 puts seem to be the other big trade on the day, going up 7,500 times. Looks like for prices ranging around 25 and 30 cents. So some interesting paper lighting up the old tape in Wendy's. Wouldn't you say, Andrew?
I would say Wendy's, yes. I find it, and it's like it looks super bullish. I think there was some closing some in the money calls. Maybe they didn't listen to Tusaw's class on, your buy right. But looks like they closed short calls, and actually those no puts didn't go up when I wrote this, but it looks like those puts are mostly sellers. Kind of, getting in there and trying to sell these puts. So we'll have to see, what's going on with them. A lot of the paper was like sort of in between the market on the no puts, but I think it was mostly just short calls closing, and then they're buying the OCT9 calls, or they're buying the 9 level calls too. So it's kind of rah-rah there with the 9 level. I mean, there was only 187 open interest and 470 traded. So maybe they think the Square Burger Company has farther to go.
Hey, a 20 lot of the OCT10s went up today, so there you go. On 0 open interest. That's the most bullish guy of them all.
This is a stock that's been $8 for like forever.
Yeah. I mean, I said it's been trending up. It's been a relatively slow trend. It broke through, like I said, the 7 handle back in July, and has been drifting north ever since. But yeah, it looks like the inertia is behind them. Then this guy perhaps deciding that his covered call wasn't the right way to go, took off that part of it, and then went further down the short put route out to November and blasted out a bunch of puts on the 8 level, saying, hey, I'm going to draw the line in the sand here again now on the 8 level. So interesting. What are the odds that those two are unrelated on the same day in a name that doesn't do that much paper? Interesting. Yeah. Interesting one to ponder. A question I shall leave up to you, dear listeners, as we roll on into our final name. One that's been on the odd block before, actually. We have surprising activity here in the ladies' handbag sector. Vera Bradley, ticker symbol VRA. I think Sebastian would be on talking about this kind of stuff. I know this is
exactly.
Deep. This is deep in his bailiwick. This and like Chico's are his favorite things. Closing today, $18.85, down about 60 cents or 3% on the day. This is the name that does about a whopping 800 contracts a day, about what you'd expect for a ladies' handbag maker, doing 17,000 contracts again today. So this one also lighting up the tape, and kind of like Wendy's, it seems like there might be some interest here, some love in them there hills for Vera Bradley. We saw first off the Nove 20s lighting up the tape 6,600 times total for about $1.35. A block of about 1,000 went up this morning for about $1.35. The rest went up in a variety of prices, less than that it seems like, because the stock sold off pretty aggressively on 4,400 contracts open interest. It seems like a lot of scattered paper going up today. SEP 20s, both the puts and the calls, going up 2,000 and 3,500 times respectively. Maybe some combos lighting up the tape up there in SEP as well. So all of a sudden, everyone and their mother diving into the ladies' handbag manufacturer. I guess they revised their guidance yesterday, came out below analyst estimates, so that of course is going to lead to a lot of bearish paper, which is probably what led to the massive spike in ADV today. What's your take on all this madness out in Vera Bradley land? Yeah,
it looked like a lot of just short option closing. Most of, I think, this paper, like the no, felt like a lot of short closing. Now, obviously, there are new opening positions because some of the OI is a little higher. The OI is higher in November, but ball came in pretty hard after a number, as normally happens, and but kind of an aggressive buying the 20 level back in November. I thought that was a little surprising. So, if you're short them, naked, fine, but I don't know if you, let's say if you wrote the 20s against some stock, I don't know why you'd be really in a rush to buy them back right now. So I think the stock traded 21 pre-market, so maybe that move up kind of scared people.
That spooked the risk manager, and he said, you got to close this off.
Yes.
He lifted the offer, didn't wait a half an hour for the vol to come in and for these things to lose 40 cents.
I don't think we're going to see Vera trading 17,000 contracts tomorrow, but it looks like just a lot of short paper closing in here. Bullish, don't really. I'm kind of ambivalent about the direction. I will say though the stock is trading like at a 6-month low. Probably one of the few stocks that are listed that is trading at a 6-month low.
Yeah, the last few months not been exactly kind to Vera Bradley. They were trading 22 back in early August and have sold off nearly 4 handles since that point. So not a lot of love.
And the IV is actually still kind of pricey for the stock. I mean, it tends to settle in the 30s, and it's still in almost 50. So, I think there's even some room if you wanted to own the stock and write the calls is still a pretty, that even the Nov 20 buy ride is not too bad for about $1 over, selling the Nov 20s for $1. So I guess maybe things are, you'd have to look at the, the fundamentals or whatever of the company. It still seems like it's making $1.50 a share or something like that per year. So, but from an option price point of view, I mean, I think the option prices are still relatively expensive. I would look at the Ox 1720 Strangle. That doesn't look like too bad of a sale either. So I think the ball probably has farther to go down in this name. That's what I would say.
Last year, if you put the chart up of Lululemon and Vera Bradley, not at the same price, but they were tracking each other. They were both motley fool stocks that had been bought broadly by the investing public. And the demographic of Vera Bradley is not the same as Lululemon. It's more of a popular price product. But I just wonder if what's going on with the stock lately is the coattails of Lululemon, because I suspect both of those are in the same hands, in that kind of motley fool followers' hands, because they appeal to the same age group, but not the same financial demographic. And I think Lulu came public in 10 or 11, and it was just, parabolic until it wasn't. So it was a lot like the Lulu story, and now the Lulu story is also clearly more cloudy.
Yeah, 2-year low for the stock.
Alex, I love it. I always look to Alex for my deep insight into ladies retail. It's good stuff.
Wait till you have a 19-year-old daughter in college, and the trip to the mall is and this is literally the case. The trip to the mall is J. Crew, Vera Bradley, Lululemon, and can we go to the Apple store? Because, my MacBook that's only 3 months old, I want to see the new one. And it's like 3 out of 4, you're not going to Apple.
I thought you were speaking from some deep personal experience. I was starting to wonder what you did on the weekends, but now that makes a lot more sense. Thank you for that.
I think I sensed some post-traumatic stress disorder too from Alex after leaving the mall. Like I can feel he got just in the shakes every time he goes.
I traded the stuff. I traded both of them. In fact, I tried to day trade Lulu today, and that trade looked real good until about the last 15 minutes, because you could buy it down almost $5 today, and until about the last 15, 20 minutes, it had recovered about $2.50 of that, and then in the last 15 minutes, it just puked a buck back. So it was still a decent day trade in hindsight. And it's easy to talk about things in hindsight, but I traded a lot of Lulu in 11 and 12, and this was one of those Peter Lynch stories. If you go to the store and they're, out on the sidewalk waiting to get in, buy the stock, it's his classic Ann Taylor story. And a lot like Lulu, the stores are much quieter today than they were in 2012. But both of those stocks are on a tear, and now they're operating companies that have got to deliver consistent earnings, and there's a lot going on with them.
I think all that talk of Lulu is the perfect segue right on into the Express Block.
The Express Block, brought to you by Options Express. Options Express lets you trade where and when you want for every level of trading. From advanced charting, free daily trading ideas, and free educational resources, Options Express is the online broker for all traders. Best of all, Options Express allows you to trade stocks, options, and futures all in a single account on powerful yet easy-to-use trading platforms, including mobile devices. Visit optionsexpress.com/OXradio for your free account. Options Express is a member of FINRA, SIPC, and NFA.
All right, welcome to the Express Block. This is the portion of the program where we get to peek behind the curtain into the innermost sanctum that is OX and Alex Jacobson's office there in the OX HQ. Alex, we were talking about Lulu on the last segment. Lulu, of course, being a big driver of ADV, at least it has been recently over there at OX. Kind of fell off the radar a little bit, but now it's coming back. Had earnings this morning, and they got just the legs cut out from under them. They issued weaker than expected guidance for the rest of the year, and the stock was off to the races. To the downside, down about 5.5% or 3 3/4 today to 65.29. And the options, as expected, were lighting up the old tape as well. They usually do about somewhere around 20,000 contracts a day, doing nearly 100,000 today with just volume all across the board on pretty much every strike. There's no really one great story to pull out of that data. But I'd imagine it was a relatively quiet day. I imagine the few calls you were getting today, Alex, were probably from Apple and from Lulu.
That's spot on, Mark. And it's funny because at some point during the day, I kind of query both of the desks, the options desk and the futures desk. And sometimes it's hard to get a free moment to query them because they're on the phone. But the option desk today was candidly quiet. And it was 3 names. It was Lulu. It was Apple, as you said. We have a big contingent of premium sellers up here, and that's picked up again after the 3-day rally. We're a big SPX house. In fact, I mentioned the other day on the show that I saw our July numbers, and I can see our numbers and Schwab's numbers, and it's funny because Schwab is a little bit of a bigger book, but in SPX, we're substantially bigger than Schwab. Because we have that contingent of premium sellers, and just saw a bunch of premium getting banged out today. And obviously, I'm assuming that if people are selling premium, they think the market's gonna grind. But you could do, October $80 out of the money iron condors and SPX for $1.25 all day today. And if you're a suitable customer for that, and you think we're going to grind here for a little bit, that protects you up to the 1770 area. And I know there are people who are thinking we could trade up to the 1700 number on the SPX, but I think 1770 is not on many people's radar, and it protects you down to the 1600 level, and I think a lot of people think there's a lot of support in the 1640, 1650 level. So really 3 names today, Lulu, Apple, and SPX, but it was a quiet day. We had one interesting question on the futures desk today because last night there was a trading halt in gold because gold had hit a trading limit, and talking to the futures guys, they fielded a call. And the caller wanted to know what was the daily limit on oil after the gold experience. And gold obviously had a rough day here, a rough night last night. And we were talking about that there's a $10 limit on the oil contract, and that's about a 9% move or about 150 vol, and kind of raised the discussion about. You and Andrew talked earlier about how low gold vol has become with all the geopolitical stuff going on. Syria and Egypt, and I'm going to open this Pandora's box and then tell you I don't want to open it, have a mutual defense pact, which is kind of interesting. And there's been all this speculation about if does somebody close the canal or does someone not let American ships use the canal, and I can hear the wheels turning in our customers' head when they start to ask stories about hitting trading limits in oil, because we did hit a trading limit in gold. So kind of interesting times in the futures market, but a quiet day on the equity side.
I think it's interesting stuff about the SPX volume. I think maybe when we have a little bit more time, we'll get back into that on a future show, because I'd imagine there aren't many retail shops out there that really do some size SPX numbers, and the fact that you guys are out there doing so much of that is interesting because that's a very meaty contract, a very high delta, very high notional value contract, and a lot of retail can't bite that off. It's
the character of the fact that we have a large community of premium harvesters. If you look at most e-commerce firms. SPY is the number one thing that trades. Apple is generally 2. I think at Schwab, SPX is 6 or 7. And I know somebody in San Francisco is just breaking a pencil because I probably talked about something I shouldn't talk about. But they're OCC numbers. You can get them. Here, SPY is 1, SPX is 2. And we do 3 times the SPX that's done on the Schwab side in a typical month. And we're overall a little bit of a smaller book. But, we're also Chicago-based. So we've got lots of former professionals. And I think in the e-commerce space, the OX book is the biggest SPX book on the street.
That's interesting. I wouldn't have guessed that. That's something I think we'll have to dig into on a later episode, because now it's time to dive right on into the mail block.
Now it's time to empty the mailbag and see what our listeners have to say. It's the mail block.
All right, everybody, welcome to the mail block. This is, of course, the portion of the show where you guys get your chance to chime in. We have time for one today, and this is the question from Contrails. Maybe he's a pilot, I don't know. He writes, "Hi, Mark. I really like your talk shows and loving all the humor. Thank you for educating and entertaining me all of those night shifts that you guys keep me in company." Well, you're welcome, Contrails. I'm glad we could help you with that. Maybe those are night shifts on your jet or wherever you are working that. We'd like to hear that we could make those quiet and boring night shifts a little bit more interesting. He goes on to write, "I have one burning question for you regarding an observation I noticed today as I was following the SPY and SPY weekly options. First off, I am a noober, but I could not find an explanation for what I saw for those weeklies that are expiring in 4 days. So what happened is that the at-the-money and in-the-money calls were not following the price of the SPY. So as SPY was fluctuating up and down, the calls mentioned above were higher in price around 10:30 a.m. Eastern Time compared with calls corresponding to the same SPY price later in the day around 1300. The call price difference was about 15%, which is a lot for a home gamer like me. Why is that? By the way, I did not check the puts. I'll look at it later today. Do the weeklies lose time? This is the key part of the question. Do the weeklies lose time value theta as the hours go by during the trading day? Or is this something related to all the mysterious Vega?" But I love that, mysterious Vega. "But I plotted the Greeks of those options on my trading platform, and they were all flat lines. Confusing. Please enlighten me more. Please, and please let me know if you get a chance to answer this on the air." Well, we're doing it right now, Mr. Contrails. And yes, one of the reasons why I wanted to highlight this question is that, yes, what you are describing is theta, is time decay in action, in living action. You watched it erode right in front of your eyes during the day. So all the stuff we talk about here on the show, the Greeks and time decay and things like that, these are very real concepts. These are not some sort of theoretical, noble idea that we're just throwing out there. These are actually things you could witness in the marketplace as you saw today. And as you're talking about a weeklies, this came in earlier this week through our Facebook. So I don't remember exactly what day it came in, but I'm guessing you were looking at weeklies for this week. So they only have a few days left to expire. So by the time the morning prices then roll ahead a few hours to the afternoon, you're going to see, all other things being equal, like it was that day you were talking about, a marked decrease in the value of those options just through the sheer decay. And what you're talking about with the flat lines on your trading platform for the Greeks, yeah, we've said that before with weeklies. Weeklies are a bit of a hard one to really model. Things like we talk about all the time on the show, like Vega and Delta, they're not really as, particularly Vega, not really as consequential when you're talking about the weeklies. There's really no time to get any vol going. They're really gamma and theta devices, as you're seeing right now, and that's why they become so popular for a lot of premium sellers in our audiences, because exactly what you're referring to. Mike, Andrew, Alex, anything to add here for our friend Mr. Contrails before we wrap up the mail block?
Just one comment, and that's with weeklies. When you're looking at the Greeks, don't look at the absolute numbers. Think about them in terms of percentages. Now, let me quickly talk about what I mean by that. You'll hear people say that Leaps have the most Vega because they have the highest Vega number. But on a percentage basis, they have very low Vega if you look at it as the change based on the price. With weeklies, to your point, Mark, they don't bounce around much, but they actually have significant Vega if you start to think about it as a percentage of the price of the option. So the one piece of advice I would give is when you model option prices, especially with weeklies, don't look at absolute values. Look at it as a percentage number. It's much more meaningful.
Good advice, Mr. Alex. Unfortunately, that's all the time we have. Thanks for writing in, Mr. Contrails. If you'd like to join him, you can, of course, post your comments on these episodes on the optionsinsider.com or find us on Twitter, twitter.com/options, facebook.com/theoptionsinsider, or hit us up the old-fashioned way, questions@theoptionsinsider.com. And now it's time to roll on into our final segment, Around the Block.
Around the Block.
All right, those car horns mean that we have time for a lightning around the block. So maybe we'll start with you, Uncle Mike Tusaw. What are you watching for the rest of this week into the weekend?
I'm just curious to see how gold and silver react after the the big day today, and see how it sets up for the big FOMC thing that we have coming out next week.
Gotta love the FOMC. Mr. Andrew, what are you watching, sir?
Similar. I'm still watching the oil volatility. And, you know, we have VIX expiration next week. We're kind of dinging around the 14 handle. So, you know, just watching these three, and, you know, the FOMC. Does anybody not think the taper is going to happen? I mean, I think the taper feels like it's kind of priced in, but the market is kind of close to its highs. We traded, 169 in the SPY. So market is definitely pretty, you know, considering what's kind of hanging around, it has some pretty, I think, kind of rosy expectations for what the Fed might do. And I don't know what the heck is rosy anymore. I can't, I'm way confused at this point about what's good or what's bad. So anyway, but that's kind of what we have, sort of a little juice here and there, but just watching them, but nothing, I would say nothing major. We lighten up usually in front of these announcements.
And Mr. Alex, take us home, sir.
Light liquidity day tomorrow, even though it's a weekly expiration. It is the Jewish holiday, and I know I can't come off sounding like a religious zealot when I talk about light liquidity on the holiday days. And then just like Andrew and Mike, gold and oil, man, that's the whole story lately. And the breakdown in gold was a bit surprising, and I would be concerned that you're going to see some more margin selling here. So laser focused on those two.
Alex, you are always laser focused on one thing or another, sir. But unfortunately, that's all the time we have for this show. Really quick, let me check in with each of my cohorts, my partners in crime, to see what they have cooking in their respective necks of the woods. Starting off with you, all the way out in the woods of St. Charles, Uncle Mike Tusaw. What's cooking on the webinar train?
This coming Thursday night, we are going to have a webinar on the White Knight strategy at RCM. We're excited about it, and I'll talk a little bit more about it next week, actually. But plan the date, this coming Thursday night, the 19th.
We will mark it in our calendars, sir. Senior Andrew, what is cooking in the land of the pit?
What is cooking in the land of the pit? September 28th, VIX event with the Street.com and Russell Rhodes on the SIBO. And if you sign up for it, you can use those dollars as a credit for the Option Pit Gold course, which is a pretty darn good deal. So if you listen to this show and you are hopelessly confused about all the Greek terms that Mark and Mike and Alex throw around, and myself, this is a good chance to educate yourself. Everybody that's taken the gold course has said to me at least once, I wish I would have taken this 2 years ago and I would have saved myself a lot of money. Because it keeps you from doing kind of dopey things. Because you actually learn how options work before you start trading them, which is the reason why Mark and I put the course together in the first place. We actually think that's important, that you need to know how they work before you go and trade them. So it's a great deal. The VIX seminar is excellent, and both Russell and Mark will just help you understand actually how the VIX works. And if you're new to it, I guarantee you it does not operate how you think it operates.
So isn't that your subtitle over there at optionpit.com? Don't be a dope.
Yes, don't be a dope. You want to try to avoid the easy mistakes, the unforced errors, as they were.
All right, good advice, sir. And last but not least, Mr. Alex, what is cooking? What's coming up in the land of OX education?
I'm just going to pick a couple days, but next Wednesday, September 18th, focus on 4 webinars. First one is protective puts and IRAs. Hour after that, we're doing an introduction into the futures market. Hour after that, we're doing option risk gauges, and we're going to dissect Delta. And then after the close, we're going to do Idea Hub for an hour. And then that weekend on the 21st, we're in Boston with a live event. All the events are free. Just come to the site and you can see the events, or you can register for the live event.
Thank you for that, Mr. Alex. No matter where you live in the U.S., OX is coming to a town near you with an event, so stay tuned to their schedule. Surf on over to OX.com, or should I say OptionsExpress.com, spell it all out for you, and you can check out the education tab there for all of those upcoming events and much more. And on behalf of Alex and Andrew and Uncle Mike and, of course, myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to this show. The numbers have been off the charts of late. Keep it up. Keep sending in those great questions too, and we'll see you next time right here on the Option Block.
The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.